Welcome to the Utah Retirement System's webinar series. While this webinar has been pre-recorded, the information is still relevant. Please see the description below for links to the different sections within the video and other helpful information. We hope you find this webinar to be a useful resource in your retirement planning.
Fantastic. Thank you very much, Corey, and welcome everyone. We appreciate your taking your time today to learn more about your retirement benefits. Today we're going to give you a really good overview of the Tier 1 system, things to consider within the system, things to consider preparing for retirement, some of these decisions that you're going to have to make. So let's go ahead and get started. We're going to jump right in. And like Corey said, if you have any questions, just go ahead and type them in, and we commit to not leaving until everyone has their questions answered. So let's go ahead and start. So the Tier 1 pension system in the public system, let me just see here, go back up here, is based on a very simple mathematical formula, right? All pensions are based on a simple mathematical formula. And the Tier 1 pension, you're going to take your years of service, right? And every year you're in the system, your multiplier, right, what you're filling up that pension bucket with is 2%. And then we're going to multiply that by your average of your highest 3 years salary. So I always like to tell members when we're doing these types of webinars and live presentations and things is that as members in this pension system, the two things that you control are your years of service and your income. Sorry, I think we need to mute a few people. So your years of service, the more years you have, the richer the benefit. And then a lot of people will sometimes say, well, I don't control my salary. Well, you do if you take advantage of those opportunities to move up within the system. We have a lot of educators who've gone from a teacher to an administrative type of position, and they've experienced really good jumps. So the more years coupled with a higher salary is obviously going to equal a bigger benefit. So take advantage of those opportunities there. So again, it's years of service multiplied by 2%, multiplied by the average of the 3 highest years. Now, oftentimes you'll hear water cooler talk that will say, oh, it has to be the highest 3 within the last 5, or they have to be consecutive 3 high years. It's your highest 3 years within your service window, all right? And whenever you have any questions about anything, we always want to make sure that you're coming directly to the source. Please contact URS, and we'll make sure you have the most accurate information. And so we take that formula, and that's going to equal your basic yearly pension benefit. Let's put this in some context here. So this example that I'm going to show you right now, this is based on a $40,000 final average salary. So we kept the numbers, round and realistic. So a $40,000 final average salary, so that's the 3 years averaged out. And so that's 30 years of service here in this example. So we know that 30 years times 2 or 2% per year is going to equal 60%, right? And this is based on a member who's age 62 with a spouse age 60. So we know that 60% of 40,000 is $24,000 a year, and their base monthly benefit is going to be $2,000, and that's what we call option 1. And here shortly, I'm going to cover the 6 payout options that you have access to, but that's going to be the base benefit there. So we'll talk a little bit more about that as we move through the presentation today, but the formula is very simple. You can do it with a notepad and a calculator, and then we'll show you some calculators here momentarily, but that's the gist of the system there. So final average, however many years you have times 2%, and that's going to be your base benefit, okay? Now, when can you retire from the Tier 1 system? So if you're age 65 and you have at least 4 years of service, you can retire with a full benefit with no reduction. 4 years of service means you are vested, and vested means you actually own your benefit. So that 4 years doesn't have to be with one particular agency. I've seen that split up between 2 or 3 agencies for some members, but you have to have a total of 4 years within the system to be able to be vested. So at age 65 with 4 years, or any age with at least 30 years of service. So those folks are the only ways that you can get your full maximum benefit with no actuarial reduction. Now, as you'll see in those brochures that Corey attached there in the literature that he referenced as he introduced today's session, you'll find more information specifically in there. But in the basics brochure, it does a really good job of covering this. So if you are at least age 62 and you have a minimum of 10 years of service, you can retire from URS, but you're going to experience a reduction there. If you're age 60 and you have at least 20 years of service, yes, you can retire, but you're not going to get your full monthly pension benefit. There will be that reduction. Or if you're any age and you have at least 25 years of service, and this applies to those members who are in the non-contributory system only. Some of you participating today may be in the contributory system, and that is primarily a pre-1986 type of system there. Some members are still on that, so that doesn't exist in that program. Now, one thing I want to talk about, and I'm going to ask for your help a lot today in communicating with your coworkers, is that there's this big confusion going around that I hear a lot actually, that, oh, you get your full benefit at 25 years regardless of your age. Well, folks, that's only going to apply if you're 65 years old. That actuarial reduction applies to members who have 25 years of service and if they're less than 65 years old. So let's talk about this because we want to make sure that you understand it. So if you're age 60, between age 60 and 65, and you decide to retire and you do not have 30 years of service, you're going to incur a 3% actuarial reduction per year. Then if you're below age 60, it's an additional 7% per year. So let's put this in perspective here on this next slide. So if we have a member who retires, they have, right here in the example, they're age 57 and they have 25 years of service. So they've met that minimum eligibility to retire because they have 25 years. But the key thing here that we want you to focus on is the age. So this member retiring at 57, and believe me, Corey and I see this often, is that they're thinking they're going to get 100% of their benefit. But here's the reality. The reduction is going to be from age 60 to 65 at 3% per year. That's going to equal 15%. Now, we're not taking away years of service. We're not taking away your multiplier. What this means, you're going to get less on your pension check. So this member right there, because they're 57, they've already incurred that 60 to 65 reduction at 15%. And because they're taking their benefit younger than age 60 at 3 years, so age 57, so 3 years to 60, 3 years times 7% per year, that's another 21%. So before this member in this example here even files for retirement, they're going to get their first check and they're losing 36 cents on the dollar right out of the gate before taxes. So you really want to make sure you're aware of how this actuarial reduction could potentially impact you. So for a member who's 63 and they have 12 years of service, 2 years before age 65, 2 years times 3%, they're losing 6 cents on the dollar. So you don't have to retire just at 60 or 62, right? So you have to be aware of that. And our online calculators will help you look at the difference there of working longer, possibly purchasing service, which we'll address here shortly. But folks, we want to make sure you're fully aware of how the actuarial reduction can potentially impact your benefit. So in the Tier 1 pension system, you have access to 6 payout options, and you will make this decision at the time of retirement. And after your first check hits, this is an irrevocable decision. So once you decide how you're going to receive your URS monthly pension benefit, it is locked in, it is irrevocable, it will stay the same for the rest of your life. So let's review these. So option number 1 is going to be the maximum benefit that is payable to you. And after you die, the money dies. So in our previous example, a few slides ago, that member was going to receive on their base benefit, right? $40,000 a year is their final average salary. They work 30 years at 2% per year, so 60%, right, of that $40,000 is $24,000 a year or $2,000 a month. So that right there, that member selects option number 1 and they have a spouse. They die, the money dies, the spouse gets nothing. And let's make sure everyone is fully aware that it's only the member and a spouse that get pension money in options 1, 3, 4, 5, and 6. We'll talk about option 2 here next. Pension money does not go to church, charities, kids, grandkids, things like that. So you want to be well aware of that. So that's option number 1, maximum benefit, you die, the money dies. Option number 2, and this applies to members who have a contributory balance from the contributory system, or if they purchased years of service or reinstated years of service, which is upcoming here in a few slides, you have basically cash in your pension. Now, after death, your beneficiary will receive the remaining contributory account balance. And what we found is that money is typically spent out because we use that contributory money to pay out your monthly pension benefit. So within 8 to 10 years, that money is spent down, in most cases, to a zero balance. So if you have contributory money and you have a life expectancy longer than 10 years, we obviously would advise you not to take option number 2. For most members in the non-contributory system, this does not apply to you. That is a contributory situation where you have cash from the pension. So now let's transition over to options 3, 4, 5, and 6. This is where the member can elect to receive less per month, and in the event of their death, they can leave their spouse and only their spouse a check for the rest of their life. So option number 3 says, after your death, your spouse at the time of retirement will receive the same monthly benefit check for the rest of their lives. So option 3 is 100% to the spouse. Option number 4, after the member's death, your spouse at the time of retirement will receive a benefit to 1/2 of your benefit. So option number 4, your benefit goes up a little bit more than it would in 3 because you're only leaving your spouse 50%. So 3 is 100% to your spouse for the rest of their life in the event of your death. 4 is 50% to your spouse for the rest of their life in the event of your death. Now we have options 5 and 6, and 5 and 6 look like options 3 and 4, but they have a very unique feature built into that, and this is something that a lot of people need to consider. So option number 5 reads that after death, your spouse at the time of retirement will receive the same monthly benefit check, just like option number 3. Now, option 5 is going to be slightly less than option 3. I've seen it be $10 or $20 a month. I've seen it be $80 to $90 a month. I've seen it be $125 a month. These spousal benefits are always based on a joint life expectancy, so it's not a set dollar amount. But let's continue reading. Where 5 is different than 3 is that if your spouse dies before you while you're in retirement, you won't stay at that reduced benefit. You're going to automatically revert back to whatever your option 1 benefit is going to be. So that's a really neat feature. 6 works like 4, and that it's another 50% benefit to your spouse. But like 5, in retirement, your spouse predeceases you, the member. You don't stay at that reduced option 6. You go back up to option number 1. That's really good. So 5 and 6, we recommend these if you have an older spouse. We recommend these if your spouse's health is not good. They have maybe some underlying medical conditions, not a really good family health history. And then for me, when I'm doing my retirement planning sessions, I encourage members to consider this option if the difference between 3 and 5 and 4 and 6 is $20, $30, $40 a month, especially if they're retiring younger. So again, let's just recap. So in retirement, options 3 and 4, you're taking less than option 1 to leave your spouse either 100% benefit or in 4, a 50% benefit. But if your spouse dies before you in retirement, you're staying at those reduced benefits. 5 and 6, you're taking a little bit less than 3 and 4, but if your spouse predeceases you in retirement, you don't stay at the reduced benefit, you revert back up to option number 1. And all that's clearly laid out there in the attached documents. So continuing on, when you guys get to retirement, there's also a feature that you can elect, and you can only elect this feature, this partial lump sum option, at the time of retirement. So there's a lot of things that you need to consider in addition to making your options, your choices 1 through 6. Also, then you have to consider, do I want to take this partial lump sum option? Option number 1, using our example numbers from earlier. So we have a member with a $2,000 monthly benefit. Remember, if they pass away, their spouse is not going to get anything because they elected to take their maximum monthly benefit. Now, with the partial lump sum option, and you'll see this in your literature, you will see this if you run a calculation online, and you will see this when you get a pension estimate from the pension department. By keeping the numbers simple here, so if you elect to take 12 months of a partial lump sum amount in advance at the time of retirement, you're going to have a reduced monthly benefit to $1,858 a month for the rest of your life. You can choose to take 24 months in advance at the time of retirement, and in this example here, it's going to be $48,000. And it's really just 24 months of the option number 1 benefit amount. So this person now has $48,000 that they advanced themselves, and now their reduced benefit for the rest of their life is $1,714 for the rest of their life, and they're not leaving their spouse any benefit at all. Now, the thing that you need to consider with taking the partial lump sum option is that if you take that money at the time of retirement, and if it touches your hands, it's going to be 100% fully taxable. So you definitely want to consult with the tax professional if this is something you're considering, because it could push you into a higher tax bracket, because at the time, if you take this much money out, it's going to get added to your income that you've earned that year. So this is a very big decision. This is a decision that you really want to think through carefully and consult the tax professional before you do that, okay? Now, another option there is to just move your money over to your URS 401k. Again, URS is a nonprofit trust. We do not charge any commissions. Our investment fees are low. On average, they're 0.37%. So for a member who doesn't have that much money in their 401k at the time of retirement, this may be a good option for them. Maybe they weren't in a position to save, and they wanted to have a little bit of liquidity available to them at the time of retirement. It's common for us to see that we have members who are not able to save, but they do have the pension and they do have Social Security, but they want a little bit more flexibility in retirement to where if they need money for a vehicle or a repair or a vacation, they can just take that money out of their 401k if they choose. Now, on an option 5 benefit, you can see here in this example, just on the basic monthly benefit alone, it is reduced down to $1,741. That member passes away, their spousal benefit is going to be $1,741 for the rest of their life. But again, as we said earlier, if their spouse dies first, they're going to revert back to the $2,000. Now let's move over to the middle column. If this member chooses option 5 and then elects to take the 12-month partial lump sum amount of $24,000 in this example here, their monthly benefit is going to be reduced down to $1,617 a month. And over to the right column, by taking $48,000 a month in this example, the member's benefit is going to be reduced down to $1,492. And if they pass away, their spouse is going to get 100% of that benefit as well. And with the middle column, the 12-month, and over to the right, the 24-month, should their spouse predecease them in retirement, they're going to go up to, in the 12-month scenario, from $1,617 up to $1,858. The spousal benefit over with the 24-month, if they elect that $48,000 partial lump sum option, their benefit is going to go from $1,492 back up to $1,714. So as you can see, there's a lot of things to consider when you're planning your monthly payout options 1 through 6, and then whether or not you're going to take the lump sum option of 12 months or 24 months. Now, here's a word of caution. Corey and I, we've worked with, thousands of members, and a lot of members have outside financial counsel. And my disclaimer is that we're fortunate to work with some amazing men and women who are partners of ours in the financial services industry. They too live by the fiduciary standard, which means they do what's morally and ethically right 100% of the time. However, like in any industry, there's some people who want to, conduct business in a way that's going to be more beneficial to them than to you. So what we want to make sure of is that if you're being counseled to take the 12-month or the 24-month lump sum option and to move that out to a product that you don't understand, we would recommend that you come in and talk to us first before you consider anything like that. Obviously, you want to listen to it. It may be in your best interest to do so, but oftentimes we hear stories where people were moved out and their money was put into financial products that were not in their best interest. So please proceed with caution if you're receiving counsel on the 12-month or the 24-month partial lump sum option. Okay, so moving on, we have some online calculators here. I'm going to take a quick sip of water. I'm going to work to launch this calculator here because we're going to do an example for you because we love when members are engaged. They're taking advantage of all our online tools, especially the calculators. So I'm going to go ahead and motion to click this here. So I'm just going to do this. And let me make sure that I'm sharing this as well. All right, so everyone should be able to see my screen here. So I'm just at the URS public website. So I'm not logging in. This is our homepage here at www.urs.org. So our online calculators are up here on the top light blue menu bar. So we'll click on calculators. And then this page here talks about calculating the three pieces of your retirement planning. When we're meeting with members, and we'll talk about our one-on-one retirement planning sessions here shortly, is that we always view retirement as that three-legged stool, a pension leg, a savings plans leg, and then the Social Security leg. So right now, over here on the calculators, we're going to focus on the pension plan side, and this is going to be leg number one. To calculate your monthly pension benefit, all you have to do is click on this top calculator here, so the Retirement Benefit Estimate Calculator. We're going to select that, and then it brings up our terms and conditions page. And we encourage you to please read this. We want to make sure that you understand that this is not a binding agreement. You're just kind of playing with the numbers, looking at things, looking at what your projected retirement could be, right? So we always encourage you to call into the pension department, and if you have any questions or schedule a one-on-one retirement planning session. It's going to advise you to adjust for inflation if you're farther out than a year from retirement, things like that. But please just understand that this is not a binding agreement. So after you've read that, down here, you're going to certify that you read and understand this, and we're going to select this, and then it brings up the data page. So you have to type in at least your first name or your first initial. So I'm just going to put in my name there, okay? And then we're going to select the Tier 1 Public Employees Non-Contributory, which is for local government, state, and school district employees. So we're going to put in Tier 1, so you have to select your system. For those of you who are in the Contributory system, that's the next one down. So we're just going to leave this here on the Tier 1 Public Employees Non-Contributory. And all that means, folks, is that your employer is paying for the benefit. So we're going to put in a birthday. I'll just go ahead and put in mine. So 5/22/1969. So that is my birthday. And then we'll put in a spousal birthday, and we'll say January 10th of 1970. Okay. Projected date of retirement. Let's just say that I'm a school teacher. I'm going to retire in June at the end of the year. I'm going to retire in 6/16, and I'm going to say 2023. And at the time of retirement, I'm going to have 30 years. Now, I'm a few years out. Right now, let's just say hypothetically, I make $50,000 a year. I'm expecting a salary increase of 2%. Do I want to adjust for inflation? Absolutely. So if you're farther than a year out, we always encourage you to adjust for inflation. And adjusting for inflation, everyone, what that does, it puts future dollars discounts them for inflation, and gives you a really good idea of what the buying power of that money is going to be. Because the cost of gas, milk, bread, and eggs, and services that you use, those go up each year on average by around 2.5%. So it defaults to 1, so I'm going to type in 2.5. Now, for those of you who are within a year or two of retirement, you can come back over here and select this little box. I'm just going to go ahead and do it now for you, where you'd put in your 3 highest salaries. So if you're a year or two out and you think, okay, I'm going to cap out at $55,000, my second highest year is going to be $53,000, my third highest year is going to be $50,000, you can go ahead and add that in, okay? So we're going to be back to $50,000, 2% salary increase, adjust for inflation, and then my life expectancy, let's just say I'm going to live to age 88 years old, and there's a little life expectancy table there, okay? And this really applies when we're looking at the spousal benefits. Then all you have to do, folks, is click calculate. And what it's going to do here, it's going to say, here is your basic monthly benefit. So your option 1 benefit in this example would be $2,415.29. Remember option 1, you die, the money dies. Here's the lump sum option. So 12 months of option 1 is going to equal $28,983.44. Or if you elect to take the 24 months, so that's 24 months times your option 1 benefit, that's going to equal $2,113.49. Over here to the right column, you'll see a break-even point, and there's a nice explanation of that below here. Basically, if you take the lump sum option, you would need to earn at least 7.37 to earn the same amount of money, right, to make up for that monthly income in retirement. So here it's going to give you your option 2, 3, 4, 5, and 6 monthly payout options. So even if you're in the non-contributory system, it's still in the calculators, still going to calculate option 2, but for most of you, that's not going to apply. So let's get and run through this real quickly while we have time. So going from the maximum monthly benefit, going down to option number 2, you want to leave 100% to your spouse. The benefit's reduced down to $2,229.57. You die, here's what your spouse is going to get at 100% for the rest of their life. Option number 4, $2,318.71. This is where your spouse says, I think I'm fine with 50%. I have my own retirement. I have my own pension. Maybe I'm also a member of URS, and we see that very often to where they have their own pension as well. And each spouse may elect to take a 50% option. Some of them take a 100% option. But in this scenario here, $2,318.71, member passes away, the spouse is going to receive $1,158.89 for the rest of their life. Option number 5, and you can see right here, it goes from $22,29.57 down to $22,15.64. For a member like this, who's going to be in their early to mid-50s, retiring, with such a small difference between option 3 and 5, in my sessions, I'm recommending option number 5 for this member. They pass away, their spouse receives the same amount at 100% until they die. But again, if their spouse passes away before them in retirement, they're going to revert back to option number 1. Option number 6, another 50% option, 50% to the spouse. Again, and if the spouse predeceases the member in retirement, member reverts back to option number 1. The middle column is going to reflect the impact of taking the 12-month partial lump sum option. And then the column next to that is going to reflect the monthly impact of what their benefit's going to be should they elect to take the 24-month partial lump sum option. We'll talk about life insurance here in a minute. That's down here calculated at the bottom for you. We'll touch on that here shortly. But folks, we encourage you to go online, use the calculator, get used to the tools, and if you have any questions at any time, you're obviously welcome to call URS. Okay, so I'm going to just click on here, and let me come back real quick. I'm going to come back over to the webinar PowerPoint presentation. So please take advantage of the calculator. So let's go ahead and move on. So how do you increase your monthly pension check? Well, I touched on this earlier. Work more years, right? The more years you have in this Cadillac chauffeur-driven pension system, the bigger your benefit is going to be. And obviously earn more money. The higher the annual paycheck, the more money you're going to be bringing home on your pension. So do whatever you can do to drive up that income. And the other way to enhance your benefit is to purchase service. So let's talk about purchasing service. So there's 3 different ways to purchase service at URS. So for those members who have ever bought years or whoever participated in the contributory system, they have a balance within their account. And you will see this on your monthly statement. And the monthly statements, or the annual statements, I should say, for the pension come out typically at the end of March, early April. They're online in your URS account. Down in the middle, after you log into your account, you'll see the Document Center, and you'll see all your statements and your tax documents there. We always encourage members to look at that document, make sure your years are reported accurately, review all your salaries. If you're using the calculator, that's a good document to have because it's going to give you all the relevant data you need. But if you are in that contributory system or if you have cash in your pension, we see a lot of members who cash that out. I'll give you an example. I met with a member a few months ago who had some service in the late 70s, early 80s, and she and her husband moved out of state. They didn't think they were coming back to Utah. She had worked a few years in the system and just elected to go ahead and cash out the money. What most members don't realize is that if you take out that money, you're also wiping out the years associated with that. But there is an option for you to reinstate those years, but it requires a redeposit or a reinstatement. So if that was you or anyone you know who may have taken money out of their pension and they want to put that money back and reinstate those years, you have to put back principal and interest, and the pension department is more than happy to help you calculate that and see what that is going to cost you. Just know that in most cases, not all cases, but most cases, it's cheaper to reinstate or redeposit than it is just to purchase years. All right. So with that, also know that on a reinstatement, you can have the money taken through payroll deduction as long as the money is fully paid within 5 years. Again, you can call the URS pension department, the service team there. They do an amazing job, and they'll help you walk through that, send you the paperwork and all things to consider, and just let you know that if it's something that's worth doing. The other way to purchase service is what we call a forfeiting service. So if you worked in, you have military service, or you have service in another state or another system or charter school service, you can buy those years into URS. You would go online, you would use the service purchase calculators, and it's very easy to do, and you can then decide if it's worth it to you to purchase those years of service. If you have that type of service where you've worked in another system, both systems need to speak to each other. So you would reach out to the URS pension department, and you would have that supporting documentation with you that you can prove and document that you had service with another agency, another entity. Those agencies talk to each other, but basically you're buying those years into URS and you're forfeiting and walking away from those years. Military members, right, those service members, they can buy those years into URS, and they have the benefit of not having to forfeit that. So they can buy those years and enhance their URS benefit and still keep their military benefit there. So if you think that's something that might apply to you, please contact the pension department and they'll help you with that. The last one is the future service purchase. And these 2 brochures here that are on my slide, these are located at urs.org, right? And 2 left from the calculators tab is going to be our publications tab. And Corey referenced that early on. So you'll see these 2 brochures here that do a really good job of explaining the process. But a future service purchase, this can only be executed at the time of retirement. And in Tier 1, you have to be age 65 to buy future years or have at least 25 years of service to do that. So a future service purchase is you at retirement, you want to enhance your benefit, and you're going to do that at your current high 3, whatever that amount's going to be. You would use the online calculators to figure out what the cost is going to be there for you. And I want to let you know that you have to buy enough future years to get to retirement with no penalty. And Corey and I see this a lot. There's a lot of confusion around this, so let me go ahead and give you a couple of examples. One time I was meeting with the member, and she had 27 years of service, and she was age 64. And she was thinking that she only had to buy 1 year to get to age 65. And that's not correct. She needed to buy 3 years of service to avoid the penalty. Why? Because she's not 65 and she doesn't have 30 years of service. So what I want to remind you is that you don't buy the age, you are buying the years. So you have to buy enough to get you to retirement and not incur that early age reduction. So hopefully that's clear for everyone. Let's go ahead and move on. So now we talked about life insurance there a moment ago, and that can be found on the bottom of the calculation that you ran there at urs.org. To add this feature on, it's available only at the time of retirement for both you, right, and or your spouse. You don't have to just buy it on you to have it for your spouse. You can also just buy it for your spouse. And the premiums for this program are deducted from your pension check every month, and the cost never increases. So you can buy an amount at $3,000, $5,000, or $10,000. So this is a really good program. You do not have to provide proof of insurability, so it's what we call a guaranteed issued product. So an example here of those numbers, what would this cost you? So for a member who's age 65 and a spouse age 62, it would be $975 for the member to have $3,000, or $10.47 for the member, the spouse, to have that coverage. And as you can see, the cost goes up if they go up to $5,000 or $10,000. Things to note here that we always like to make sure of, that this is prorated over a 4-year period. So after year 1, it's 25%, 50% after year 2, year 3, 75, and 100% at 4 years in retirement. We've also experienced situations, and I had this happen about 1.5 years ago. A member came in, and her spouse had purchased this program for the both of them, and what she didn't realize was that because her husband and she elected to add this on at the time of retirement, well, her husband passed away, and she was going to continue on with his monthly pension check, but she still had this life insurance, and now the premiums didn't exist any longer, right? The premiums are waived should the member pass away first. So there's always these little neat, unique benefits, and what I like to call the nooks and crannies of the system there, that if you understand these, you can really be prepared to make sure you're looking really good as you guys transition into retirement. So now, what if I die before retiring? This is a really good question. So know that there's a couple of benefits built into the system here. So one is called the death benefit. A single payment equal to 75% of your highest annual salary. So that's going to be paid out to any beneficiary or beneficiaries that you have on file. But please know this. This is a payout from the pension department. Therefore, it would be taxable once it's received. Life insurance is not taxable. But again, this is a payout from the pension. So for that member who has $40,000 of their highest income, let's just say 1 year, their highest year was $40,000, their beneficiaries are going to receive $30,000, and then they'd be expected to pay taxes on that. And that's in addition to any group life insurance you may have or any private life insurance you may have. So this is an often forgotten benefit that is built into the Tier 1 pension system. Also, there is a career benefit. How much of your pension would be left to your spouse if you died before retiring? So if you've been married for at least 6 months and you qualify retirement and you're not retired, or if you have at least 15 years of service. So let's just say this member here is 62 and they have 11 years of service, they haven't retired, well, their spouse is going to get their benefit because they would have qualified for retirement. Or a member who's age 60 and they have at least 20 years of service, they're eligible and qualify for retirement, but they're still continuing to work. Now here at the bottom, if you have at least 15 years of service, and if you have a pen and paper, go ahead and write this down. This is really good to know, that if you have 15 years of service, you pass away, you haven't retired yet, your spouse is going to get 1/3 of your pension benefit payable at option 3. So again, if you have 15 years or more, it's going to be 1/3 payable to your spouse at option number 3. If you have 20 years of service, that gets increased to 2/3 of your option 3 benefit. Now for members who are still working, they have at least 25 years of service, they pass away, they hadn't retired yet, they're still on the job, their spouse is going to get 100% of their pension benefit payable at option 3, and all of these do not have the early age reduction associated with. So please be aware of that. So when in doubt, if you guys are doing your estate planning and talking to your spouse about what if scenarios and just doing really thoughtful financial planning and future planning, just let them know if anything happens to you, please be sure to call URS and we'll help you navigate all of this. And down there at the bottom, there's that little note there that says this career benefit is in addition to the death benefits. So those are 2 separate benefits that are built in to the retirement system there, okay? So now let's talk about steps to retirement. There are some steps and some logistics that we want you to be aware of. And for those members who, and again, thank you for participating with us today. Normally we'll have our seminars going on. We had to cancel all those, unfortunately, this year due to COVID. So keep your eye open. Hopefully in January we'll be able to post our 2021 schedule there. But we cover a lot of this in great detail. So the more often you engage with us, even if that's just for a few hours per year, as you gear up and get ready for retirement, you're going to know exactly what you need to do. So the steps to retirement are this, and we're going to walk you through this. So if you have a pen and paper, go ahead and start taking some notes. So if you're 2 to 3 years before you retire, right, please call the URS pension department and request a pension estimate. A pension estimate, I like to refer to it as a conservative soft audit of your years of service and your income as it's been reported to us by your employer or by your employers if you've worked for more than one agency throughout your career. You'll call the pension department, and they'll ask you for your social, ask you to identify yourself, and give us your address and date of birth and spouse's name and date of birth, and maybe list a couple of beneficiaries there. And they'll ask you some questions. When do you want to retire? And you have to let them know what month, what day, either the 1st or the 16th, right? We only retire people twice a month. And then what year you want to retire. And then if you plan on purchasing any years. So that pension estimate, they're going to calculate those benefits. And it's a conservative soft audit. We don't include the last 6 months worth of income. We're not projecting or factoring in future pay raises. Why I like people to do this is because the most important thing is verifying those years of service, making sure we have everything reported accurately, and then also making sure the funding associated with those years has been received and been reported accurately as well. So it's kind of a pre-scrub of your file as you're gearing up for retirement. What they're going to send you is a document that's going to look like the calculation that we just ran by using the online calculators. If you want it available in a hard copy, you have to ask for that. What we do now is we're going to let you know when it's going to be ready by email. And depending on their workflow, that can take 2 to 3 weeks. It can take 4 to 6 weeks. So if you're retiring at the end of the year, you're going to also be retiring with a lot of other state employees. So we get pretty busy around that time after October through the end of the year. Or if you're in the education system or just plan on retiring in June, between March, April, and May, we're pretty busy, so you can expect those pension estimates to take a little bit longer. But what they do is they'll notify you by email that your pension estimate is ready in your online account. You will then log into your URS account, and in the bottom center of the home page will be that document center, and you'll click on the link that says Current Retirement Benefit Estimate. You can run up to 2 scenarios, and they're more than happy to do that, but please don't ask them for any more, because at that point, then we're going to ask you to just go online and navigate those yourself on the online calculators. But we're more than happy to run up to 2 scenarios there. And then moving forward, we want you to call back at least once a year to do that. So call and get that pension estimate. You can see the pension department phone number is right there at the bottom of your screen. Go ahead and write that down, the 801-366-7770. We already talked about this. You have to decide, do you want to retire on the 1st to the 16th of any month after your last day of work? So you can work up to the day before. So if you work on, let's say, the 16th of the month, right now you push yourself out back to the 1st of the next month. So you can work up to the 30th or 31st, or right up to the the 28th there in February, or up to the 15th of any given month. So please be aware of that. If you work on the day of your retirement, now you delayed that process by 2 weeks. 2 to 3 months prior to your retiring, we want you to call and make an appointment. Now, right now, we're not doing one-on-one face-to-face appointments, but we do have our advisors at URS in the pension department who will gladly meet with you and walk you through the paperwork, make sure that you understand everything, give you the opportunity to ask questions, and most importantly is to make sure that that application packet is complete. So you can call and just request that application. They'll get that out to you in the mail, and then when you're ready to submit that back, you can call, schedule a time. They'll walk you through all that and make sure it's completed accurately so we don't get caught up going back and forth with signatures and dates and things like that. Now, things you need to submit and be prepared to have on hand when you submit your retirement application. So here's some things you want to go ahead and have on hand. And photocopies of these are fine. You do not need originals, but you at least need to submit a photocopy. So you need to have your birth certificate, your spouse's birth certificate, a marriage certificate. It's funny the stories we hear when people say, I have no idea where that is. So you're going to need to find that, so your marriage certificate, and then a voided check or a photocopy of a voided check. Because what we do now is we really encourage everyone to go direct deposit. It is definitely the most safest, secure way for us to get you your monthly pension check. If you're old school and you like to receive a hard copy check, there's going to be a monthly fee to do that, which I believe is $25. So just go ahead and take advantage of direct deposit. So moving on, here are some things that you want to consider. So your pension payment. Please realize, everyone, that it can take up to 90 days for your first pension check to arrive. And a lot of people ask, well, why does it take so long? If I retire, why does it take 3 months to get me a check? Well, after you stop working, we have to wait for the final pension payment to come in from your employer. Any contributions that you're having into your savings plans department, we need to go back and make sure that you are actually terminated. There's forms that we have to have signed called the verification of termination. We have to make sure that we've double-checked and triple-checked your file. It goes through multiple hands to make sure that it's accurate. But please know this. Yes, it can take up to 90 days to get your first check, but your first check is a biggie because it's retroactivated back to your date of retirement. So you're not losing out on any money. But we want to make sure and stress the importance for you of being financially prepared to have living expenses for up to 3 months. All right? The pension checks are paid out on the last business day of each month, and they're ideally put in through direct deposit. So again, sometimes it can come sooner. You may hear a coworker, oh no, I got mine within 45 days, or I got mine very quickly. Please be financially prepared for up to 90 days. If you get it any sooner, then it's Christmas there for you. All righty? So let's move on with some things to consider. In our pension, there's a cost of living adjustment, or a COLA. This is what we call your raise in retirement. So your pension benefit doesn't stay flat in retirement, because you would be going backwards financially, because your money would be losing buying power because inflation keeps going on and on. The cost of goods and services increases by, on average, 2.5% per month. So know that the COLA, the cost of living adjustment, is calculated annually on the anniversary of your retirement date, and it's equal to the rate of inflation based on the CPI, or the Consumer Price Index, where they just take a basket of goods and services and just see what's happened there in the market. Understand that it's a simple COLA with a maximum of 4%. If it ever exceeds that, you don't miss out. It's just held for you in reserve. So we haven't had this issue for a very, very long time, but who knows what can happen in the future. So the difference, folks, between a simple COLA and a compounding COLA is that if we have a member who has a base monthly benefit of $3,000, and let's just say the first year COLA is going to be 3%. So going into year 2, their monthly benefit is now going to be, or let's just say $2,000 is using the example numbers here. So $2,000 at 3%, let's just say the COLA is 3%, that's going to be $60. So going into year 2, their monthly pension check is going to be $2,060. Now at the end of year 2, let's just say they issue out the COLA again, and it's another 3%. Some people would think that it's going to be 3% of $2,060, and it's not. It's going to be 3% back on that base benefit of $2,000. So again, that's going to be another $60. So moving into year 3, the monthly pension check is going to be $2,120. So that's how a simple COLA works. It keeps going back to the base benefit. A compounding COLA is kind of like a snowball, to where if it were compounding, it would be in year 2. If that were 3%, it would be 3% of the $2,060. So nice way to kind of compare and contrast that. But just realize that that is your way to keep up with inflation. I have met so many members at our retiree seminars who've been out of the system for 10, 15 years, and their COLA is bringing them in an extra $300, $400, $500, $600 a month. Again, that's going to be based on your income and the pension formula, but just know that your money is not losing buying power. So we're really happy to have this COLA built into the system. So let me give you an example here of the COLA history, or illustrate what it's been back to 2013. So the COLA is going to be calculated for 2020 in January of 2021. So as you can see, back from all the way from 2013, it was 1.5%. 2015, not too good, not a good year there. And that just means the consumer price index, it wasn't that high. Back in 2018, 2.4%, 2019, 1.8%, and I absolutely have no idea what it's going to be moving forward here into 2021. If you're interested in that and keeping your finger on the pulse of what's going on, just on our home page, you can just go to the search box and just type in COLA, and it'll bring you to the link in the history of the most current COLA percentages there. Moving on, 3 things to consider. Number 3 here are taxes. Yes, unfortunately, your pension is subject to federal and state income taxes. You can change your withholdings at any time with online or by submitting a W-4P, a pension form there. So you can tell us what you want to have withheld for both state and federal income taxes. You're going to receive a 1099-R form, and if you're signed up for electronic documents, that's just going to be located in your document center at urs.org once you've logged into your account, and that is a form you're going to use to file your income taxes with. My recommendation is before you retire, sit down with your tax professional, kind of let them know what your pension's going to be, if you're going to be filing Social Security, if you're going to be taking money out of your savings plans. That way you're not having too much withheld or not enough. And sometimes we see that there's not enough withheld, and then you get a tax bill that you weren't anticipating. So always consult with the tax professional, but just know you can make those adjustments online or through paper at any time. Now, let's transition in our things to consider here on post-retirement employment. Corey and I see this often, and there's a lot of confusion around this, so we just want to make sure that you're aware of this. So if you retire, you filed your paperwork with the retirement office, and you come back to work with any URS agency within 60 days, here's what's going to happen. Now, folks, let me tell you, if you leave URS, you file for retirement, and you go work with any other agency or any other employer in the private sector or even a charter school that doesn't use URS, this doesn't apply to you. This only applies if you come back to a URS member agency. So when in doubt, always be certain. Here's what's going to happen if you do decide to come back to work with the URS agency within 2 months of retirement. Automatically, your retirement check is going to be canceled. Now, you can earn additional service credit, right, if you're eligible, if you're considered benefited and you're eligible to receive the benefit. And any new service that you earn will be vested. Again, vested means you own the benefit. So any new service is going to be vested after 2 years of employment. Next is if you retire and it's after 60 days, and within 12 months, so less than 1 year, here's what's going to happen. So you can still continue to have that monthly pension check, your retirement check, come in every month. You must work in a non-benefited position, right? So no health care, no benefits can be provided to you. And your salary is limited to the lesser of $17,044.88, and this changes each year, or half of your final average salary, right? So whichever the lesser of those two. This can be very restrictive, and it's a lot to monitor. Oftentimes, we will see educators who retire and they want to go back into the system as a sub. And if you can monitor that and know that you're not going to earn any more and you're okay with not having any benefits, great, that might be a good vehicle for you. But please be aware of that. That is the member's responsibility. It's not the employer's responsibility, and it's definitely not URS's responsibility to monitor that. Okay, so that is up to you to keep your finger on the pulse of what's happening there. But it could be a good opportunity for the members who are wanting to go back to work and have a little bit of extra income coming in. Now, this last way, and this is the way I always recommend it, it's probably what I call the most cleanest way, that if you retire from URS and you have any plans to come back to a URS member agency, the best thing to do is just stay out of the system for 1 year from your date of retirement. Because if you do that and then you want to come back, you can continue to receive your monthly pension check, right? Or if you want to earn new service, you can cancel the check and you can earn new service. You can get full health care, right? You can have anything you want. You can put your paychecks into your 401k. The employer's not allowed to put any money into your 401k. So what I recommend for people who leave, they want to keep their full monthly pension check, and they want to come back and earn a full salary and have health care, which is what most people want and need, is to wait the 1 year. Now, for those members, I'm going to back up here. We see this get confused very often, to where we'll have people who leave the system, and they're coming back to a URS member agency after 60 days and less than 1 year of retirement. And then they do that. Let's just use an example of a substitute teacher. They're retired in June. They're going to come back in the fall, and they're going to be a substitute. And let's just say they substitute all the way through the end of that same year. So they stop working. Now they want to come back full time. Is their year mark from when they retired in June? Is it going to be June of the following year, or is it going to be January of the year after that? It's going to be 1 year from that. So if you elect this option, just realize that you're going to continue to push out that year of separation. So the benefit is, and I can't stress this enough, I think it's the cleanest thing to do for the majority of our members to stay out of the system for 1 year, keep the check, come back, get your benefits, and then you're good to go. All right. So any other questions, we can talk about that afterwards, and you can just submit a question to me and Corey. Okay. So, folks, that's what we have for you there today. So we're going to go ahead, and I'm not sure what time it is. Let's see here. It is exactly, wow, it's 1 o'clock, so we went exactly 1 hour there. So Corey and I will gladly stay online and answer any questions for you. We greatly appreciate your participation today. And if you have any questions, or if you want to read more literature, or you're just looking to get a little bit more insight, what you can do is you can schedule a one-on-one retirement planning session. And how you schedule that is you would go online, so you're logged in to your URS account, and once you're in, the top right tab is the Education tab. So under the Education tab, you'll see one-on-one. You'll select that, and then from there you can select what type of session you would like. Right now, just due to COVID, we're not doing one-on-one sessions in person. We're doing them virtually, so you can schedule a phone session, or you can schedule a WebEx session, which is a little bit more video interactive there. And at the end of that, we'll show you what that's going to look like for you. But the purpose of this session and who it's good for members of all ages, regardless of where they are in their career. So somebody who's 20s, 30s, they just want to make sure they're on the right track. Somebody who's a few years out or even a few months out of retirement, it's perfect for everyone. But what we're going to do is we're going to calculate those numbers on your three-legged stool: your pension, your savings, your Social Security. And we're going to let you know what percentage of your income you're on track to replace when you retire. So we'll reflect that as a percentage and as an inflation-adjusted dollar amount. So, folks, that is a free service. So I would highly encourage you to take advantage of that. If you've been in before for one of those, hopefully you had a really great experience. You don't need to come back every year for an update. I would say every 4 to 5 years, if something major changes to where you got married, or you experienced your spouse passed away, or you took a new position and you had an opportunity to go earn an extra $10,000, $15,000, $20,000 by making a career change. You left one agency, but maybe you went to another URS member agency. So if anything like that happens, you can come in again, obviously. But right now, if you come in once, you probably don't need to come back and see us again for another 4 to 5 years. But if you haven't done it, highly recommend it. So please take advantage of that.